Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of our InvesTips podcast. In today's episode, we're going to analyse gold's role as a safe haven, especially amidst volatility like we've experienced so far this year, especially in Q2 since Liberation Day. Joining me today is Manpreet Gill, who is our Chief Investment Officer for Africa, the Middle East and Europe at Standard Chartered based in Dubai. Manpreet, thanks so much for joining us.
Thanks, Steve, for having me. It's always great to catch up, especially when it's on a topic that's so relevant and given where markets are today.
Absolutely. Now, I guess gold has been a key player in the global economy through the centuries. So let's take a bit of a longer term view. This is especially important when there's uncertainty and distress. And gold seems to actually be gaining some popularity as a safe haven, as a hedge against economic and policy challenges such as inflation, geopolitical risks, and market volatility. To begin, why don't you give us an overview of gold and maybe touch on its significance?
Sure, Steve. What I'll do is let me start by looking at gold from an end user perspective, since that's what most people will be most familiar with. I think for most individuals, gold is a good choice for jewelry and ornaments. We know it's a timeless symbol of wealth and success. And in recent years, we've seen a rise in its use in electrical equipment for usually longevity and improved performance. Now, these, of course, are some drivers of gold, but we know gold is also made its way into investment portfolios because of some of the characteristics you described, holding up well during crises and periods of inflation, and of course for having relatively low correlation with traditional assets like stocks and bonds. So in terms of the investment side of it, I think the key characteristic that really jump out is we know gold is known for its relative stability. It acts as a hedge against inflation. It has a low correlation with stocks and bonds over the long term, and it's seen as a safe haven asset during periods of crisis.
Okay, so that's a great summary of why gold is important and popular. Maybe if we look at the performance against major fiat currencies over sort of 40 years, I guess then gold looks like a pretty good inflation hedge. During inflationary periods when the purchasing power of fiat currencies takes a hit, gold seems to have maintained or even increased in value. So that precious metal is in limited supply, I guess, as being a significant factor. But could you walk us through some of the periods of high inflation and how gold has performed then?
Sure. No, there's a lot we can learn from gold's history. So let's look at some of the key lessons. Now, if you recall, one of the most inflationary periods in recent US history was the period between 1973 and 1979, when annual inflation averaged over 8%, primarily led by the oil price shock. Now, over this period, gold gained almost 35% annually, which really underpinned its status as an inflation hedge. But at the same time, we had the Fed, which managed to tame inflation via a sharp series of interest rate hikes. And as a result of that, gold actually shed much of its gains. For instance, if you look at the period of policy tightening between 1975 and 1985, gold experienced many instances of negative annualized returns, with one such decline exceeding 30%. Now, more recently, we had a period of elevated inflation over 2021 and 22, when US inflation breached 9% in the middle of 22. During this period, gold also hit a cyclical high, which also supported the view that it acts as a hedge against inflation. But the other key lesson, of course, is that these gains, while they're high, when inflation really surges, these gains also tend to reverse when the Fed hiked aggressively, to combat that inflation. So that's, to me, one of the key learning periods when you look at both periods of inflation and, of course, when the Fed sort of reacts to that through higher interest rates. Historically, higher bond yields, especially net of inflation, and a stronger dollar have also been two factors that seem to work against gold.
Yeah, that makes sense, I guess. So gold, I guess nothing is a perfect safe haven at all times and in all scenarios. And there are obviously economic market cycles and in all assets. And obviously interest rates, as you mentioned, is a significant force. So it's not a catch-all for all environments.
Absolutely, and often say there's no such thing as the perfect safe haven. But at least as far as gold is concerned, if I take a broad sweep over the past 50 years, gold's average annual return has been in the region of about 8%. So despite some of those temporary headwinds, the long history suggests gold can provide inflation-beating returns, at least in the long term.
Yeah, and I guess that's the sort of almost the minimum requirement for investors, right? That they must have a portfolio that stays ahead of inflation over a long period of time. So over 5 decades now, over the last 5 decades, gold has shared a low correlation with equities and a negative correlation with bonds during inflationary periods. But then during crises, markets often turn to gold and bonds for safety, which can lead to a slightly positive correlation between the two. So, can you share some light on how good gold is as a portfolio diversifier?
Absolutely. I think you made a great point there that you get the positive correlation in gold and bonds during periods of market stress, but you get a very low correlation over much longer periods of time. Now here maybe it's worth bringing up an analysis that's been done by a leading global bullion dealer, and this analysis showed that including gold in a portfolio led to stronger performance compared to a portfolio that just held the standard 60% equities, 40% bonds over a 20-year period. And I think what's more interesting is that it turns out that the portfolio with the highest gold allocation in the study, which was around about 10% allocation to gold, that ended up being the top performer relative to example portfolios that held smaller amounts of gold. Uh, the portfolio that contained 10% allocation to gold was also the only one to more than double over that 20-year period. And the last point, of course, that jumped out is that during equity bear markets, the portfolios with higher gold allocations saw smaller dips relative to those that held smaller or no allocation to gold. So, uh, you know, eh, ups and downs aside, I guess you can't really ask for more than that.
Yeah, I guess it does sound like a win-win, doesn't it? You touched on gold holdings holding ground during bear markets. As we all know, a broader financial crisis can be a major trigger for market downturns, and we've had some major ones such as the dot-com bubble in the late 1990s, early 2000s, the global financial crisis 2007, 2008, the sovereign debt crisis in Europe, and then the COVID market crash. I'm sure our listeners would be interested to understand how gold did during those events.
No, indeed, and I think from most investor's perspective, the real test of gold comes during his time of crisis. And I think when we went back and checked the data, it hasn't really disappointed. Gold outperformed the S&P 500 and other commodities in most past crisis events, including the specific examples you had mentioned. Gold's low correlation with traditional assets, as we just discussed, did help reduce portfolio volatility, which overall had a stabilizing impact even during those equity bear markets. And finally, what's interesting is that gold, of course, does not carry any credit risk. So that makes it ideal during crises where credit related losses were higher than usual.
Okay, so we talked about crises. Maybe talk about recessions. And just before we sort of get your views on how it performs during recession, I guess it's important to draw a distinction between the two. Obviously, they are similar and they can overlap with each other, but a crisis is a sudden, unsettling event like a war or a bank run, whereas a recession is a prolonged period of economic decline. So a crisis can obviously trigger a recession, but that doesn't have to. And not all recessions begin with a crisis. So what about gold in an environment when you have a recession?
Sure. Well, let's go back to, I guess, the recessions themselves. So, according to the NBER in the US, which dates economic recessions, there have been 8 recessions since 1973. And in 6 out of those 8, gold outperformed equities by over 35%. So, a strong sort of starting point there. The only exceptions, the two periods when it did not outperform, were 1981 and 1990. Now, each one had some unique characteristics. In 1981, we know that interest rates were being aggressively hiked by the Fed to combat rising inflation. And as we know from the earlier part of our conversation, gold tends to perform poorly when the Fed is hiking rates aggressively. So that explains 1981. 1990 was unusual in the sense it started a period when most major central banks were starting to reduce their holdings in gold and hence sort of place sort of downward sales pressure on the gold price itself. But apart from these two instances, gold did play a strong role as a safe haven during recessions, besides, of course, lending a stabilizing hand to portfolios during those recessions.
Okay, so that's pretty encouraging. I guess we've covered quite a few scenarios now. I guess the one that we haven't looked at yet is stagflation. We sort of referenced it a little bit when we talked about the mid to late 1970s, which is when the US went through stagflation, a period of inflation was high, but the economy wasn't growing. And as you mentioned, that was due to oil price shocks. For investors, these periods are extremely tricky, right? And policy stimulus is constrained because of the fears of inflation, but the economy is struggling. So, how did gold perform during this period?
So I think during these periods, they're relatively rare. So we do have relatively limited data, but they have been pretty notable through economic history. Um, Now, depending on how you define it, during stagflation, investors do seek safety, which works in gold favor. And during the stagflation period that you mentioned, gold returned over 20% returns, which ranked it highest relative to other major asset classes. So while there is a little bit of detail around how you define the specific periods, for at least the analysis that we've done, gold tends to shine brightest when the economy, does turn stagflationary.
Okay, so I guess gold's track record speaks for itself. Now, can we explore how our audience can incorporate gold into their portfolios? I've always felt that investing is just the first step, and picking the right vehicle is really what makes the difference. So, from physical gold to digital options, there's so many ways to invest. Could you give us a quick guide on how people can actually invest in gold today?
Absolutely, I'm glad you brought that up because getting the right form of investment can be quite important to achieving the investment return that an investor expects. When it comes to gold, at a very big picture, you can invest in the actual physical metal itself, or invest virtually in some instrument that mirrors the performance of gold. Now, we know gold bullion, coins, jewelry are among the more common forms of investing in physical gold, but there are some drawbacks of this channel, like insurance or storage costs. So I think that's, the physical option itself. But besides the insurance and storage costs, you of course have making charges and some purity concerns, especially when it comes to jewelry. So those are the trade-offs when it comes to physically owning gold. Now, on the virtual side, there are several options. Gold funds are a popular way to invest in gold without actually buying physical gold. These funds, of course, invest in gold bullion, or it could be shares of gold mining companies or gold ETFs. It's convenient, can be achieved with relatively small amounts of capital, but the drawback, of course, is that performance may not always align with the price of raw gold because you come with a number of costs of owning funds themselves. Now, gold ETFs tend to hold physical gold bullion as their underlying asset, and so tend to track the underlying gold price more closely. They offer arguably a bit slightly better liquidity compared to gold funds because they can be traded intraday. But the trade-off with that, of course, is that they tend to be exposed to higher intraday price volatility as well. A third route, of course, is to go in gold equities. That's a slightly more indirect way to gain exposure to gold via, for example, stocks of companies that engage in the exploration or production of gold. Now, compared with owning gold funds or ETFs, the risk is arguably higher here because the risk to the stocks is not only from the price of gold, but many stock-specific idiosyncratic factors such as regulatory changes, environmental concerns, or other cost factors that go into an equity price. And finally, of course, a fourth option is gold futures and options, which are, of course, financial derivatives that derive their value from raw gold. But these, of course, are much higher risk options and not always suitable for all investors unless you really understand the derivative market well. So, a lot of options, but when thinking about trying to choose the right option, I think it's very important to really step back and say what's an investor's goal by getting that gold allocation, how much risk you're really comfortable with, and how involved you want to be with the whole process. On the cost side, I think it's important to consider the costs, liquidity, the reliability of any platform, and of course, any tax or insurance considerations that might be very specific to any investor.
Okay, Manpreet, that's all we have time for today. Thank you so much for your insights. I think it's clear from our discussion that gold can strengthen a portfolio's resilience and wealth preserving capabilities, beating inflation over time. Not over often doesn't only offer protection when markets get rough, but also lends stability to your investment portfolio in the long term. So, whether you're a seasoned investor or just starting out, there's a way to gain exposure to gold and to tap into its stability and strength. With that, we've come to the end of today's episode. Manpreet, I would like to thank you again, and also thank our listeners for tuning in today. If you'd like to know more about our view on gold against the current landscape, please visit the link in the podcast description. Until we catch up again, please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.